Most people think a bank is basically a giant vault. You put your paycheck in, it sits there, then you spend it later. Simple. Except that's not how banks work at all. Banks are some of the most profitable businesses in the world, and they don't make that money by babysitting your cash. They make money by moving it. Every paycheck, mortgage, debit card purchase, business loan, and credit card payment is part of one massive financial system that most people use every day without understanding. So, in the next few minutes, we're fixing that. By the end of this video, you'll understand what banks actually do, where your paycheck goes after you deposit it, why banks pay you interest but charge much more on loans, what happens during a bank run, and why modern economies couldn't really function without banks. Throughout this video, we'll follow one thing: your paycheck, because the moment it hits your account, it starts doing more than you think. It's payday. Your paycheck lands in your account. You check your banking app, feel rich for about 5 minutes, then remember rent exists. Most people imagine that money just sits inside the bank waiting for them. It doesn't. A bank isn't a storage company. It's a business. And businesses don't make money by letting valuable things collect dust. Imagine buying 10 taxis and never letting anyone drive them. That's basically money wasted. Banks see money the same way. Money is useful because it can be lent, invested, transferred, and used throughout the economy. That's their business. So what actually happens when your paycheck arrives? Your account balance goes up. From your perspective, that's all you notice. But legally, the bank now owes you that money whenever you want to withdraw it, according to your account terms. That sounds strange because we usually say, "My money is in the bank." In reality, the bank has received your deposit and now has a responsibility to return it when you need it. Here's the important part. Banks know that not everyone withdraws all of their money on the same day. Some people get paid today, some tomorrow, some spend immediately, some save for months. Because withdrawals happen at different times, banks don't need every deposited dollar sitting in cash. Instead, they keep enough available for everyday withdrawals and use much of the rest to support lending. That's where the real business begins. Imagine someone wants to buy their first car. It costs much more than they currently have. Instead of waiting years to save enough, they borrow the money today. The bank provides the loan. The borrower agrees to pay it back over time with interest. Interest is simply the price of borrowing money. You're paying for getting access to money now instead of later. The exact same idea applies to mortgages, business loans, education loans in many countries, and personal loans. Banks are connecting people who currently have money with people who currently need money. Without banks, finding someone willing to lend you hundreds of thousands of dollars would be difficult. Imagine posting, "Anyone got enough cash for my house?" Probably not the most reliable financial strategy. Now, here's where banks actually make money. Suppose the bank pays you interest on your savings account. Now, suppose it lends that same pool of money to borrowers at a higher interest rate. The difference between what the bank earns and what it pays is one of its main sources of income. This is called the interest spread, or net interest margin. Think of it like a grocery store. A grocery store buys products at one price and sells them at a higher price. Banks do something similar, except the product is access to money. Of course, the difference doesn't become pure profit. Banks have employees, computer systems, fraud prevention, customer service, regulations, buildings, and operating costs. Some borrowers also fail to repay their loans. That risk has to be covered too. If a complete stranger asked you to borrow $10,000, would you say yes? Probably not. Banks ask the same question every day. Before approving many loans, they look at information that helps estimate whether someone is likely to repay. That might include income, existing debt, repayment history, and other financial information. They're not trying to judge people, they're trying to manage risk, because lending money to someone who never pays it back is a terrible business model. Nobody wins. Imagine lending your entire paycheck to one person. If they repay you, great. If they disappear, well, that's awkward. Banks avoid this by spreading their loans across millions of customers. Some loans are for homes, some are for businesses, some are for cars, some are credit cards. Some borrowers repay early, some repay late. A few don't repay at all. By spreading risk across many borrowers, one bad loan is much less likely to cause major problems. It's the financial version of not putting all your eggs in one basket. Credit cards confuse a lot of people. They're not free money. They're short-term borrowing. When you buy something with a credit card, the bank pays the seller. You then repay the bank. If you pay your full statement balance on time, many cards don't charge interest on new purchases during the grace period. If you carry a balance beyond that, interest can be charged according to your card's terms. Banks may also earn revenue when customers use their cards for purchases, although the exact process depends on the country and payment network. That's why banks compete so hard to offer cash back, airline miles, or reward points. Those perks help attract customers. Interest isn't the only way banks make money. Many banks also earn income from fees. These can include monthly account fees, international transfer fees, overdraft fees where applicable, payment processing fees for businesses, and charges for certain financial services. Not every bank has the same fee structure. Competition means some banks focus on low fees, while others offer more services. Either way, fees are another piece of the business. 20 years ago, going to the bank was normal. Now you can deposit checks, transfer money, freeze your debit card, and pay bills without leaving your couch. That's incredibly convenient. But digital banking isn't free to run. Banks spend huge amounts on software, cybersecurity, fraud detection, customer support, and maintaining reliable systems. Every time your banking app works in 2 seconds instead of 2 hours, there's an enormous amount of technology making that happen behind the scenes. Now imagine everyone suddenly believes their bank is in trouble. They all rush to withdraw their money immediately. That's called a bank run. Banks usually don't keep every deposited dollar as cash because much of it supports loans and other banking activities. So if almost everyone demands cash at once, even a healthy bank can face serious problems. This has happened at different times throughout history. To reduce that risk, many countries have regulations, central banks, and deposit protection systems designed to increase confidence in the banking system. Trust is everything. If people believe the bank is safe, the system usually works smoothly. If confidence disappears, problems can spread very quickly. So why do banks exist at all? Because they make money move efficiently. They connect savers with borrowers. They make payments possible. They help businesses expand. They help families buy homes. They allow entrepreneurs to start companies. They keep money flowing through the economy instead of sitting idle. Without banks, borrowing would be slower, payments would be less convenient, and economic growth would be much harder. Banks aren't perfect, but they play a central role in how modern economies function. Your paycheck enters your account. The bank now owes you that balance. It keeps enough money available for normal withdrawals. Much of the rest supports lending. Borrowers pay interest. Banks pay depositors less interest on many accounts. The difference helps fund the business. Banks also earn money from fees and payment services. They manage risk by checking borrowers and diversifying loans. Digital banking makes everything faster. The entire system depends on trust. So the next time your paycheck lands in your account, remember this: it isn't just sitting in a digital piggy bank. It's part of a financial system that's constantly moving money through the economy. If this video finally made banks make sense, leave a like. And if your paycheck disappears 2 days after payday, that's probably not the bank's fault.